broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios here in Mumbai. I am Prashant, as always, with me, my colleagues Sonia and Surabhi. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Surabhi. And today's going to be an important day, right? Yesterday, you saw that knee-jerk reaction post all the data that came out of SVB Bank as well as the Signature Bank. But today is going to be a real test of whether that downtrend continues. For starters, at least, the SGX is quiet this morning.
Yeah, it's got a bit of a bounce, a bit of a green.
I can just say that this wasn't planned, viewers. Prashant and I are in shades of white. We're not trying to be the doves here, but it's just coincidence. Just putting that on the table.
I mean, I just wear what they give me. So,
Same here.
You know, but I'll tell you what, guys. This is financial history being made tick by tick, right? We live, as they say, may you live in interesting times. And I think this is as interesting as it gets. Sometimes painful, though, as well, right? So let me just quickly run you through what's the latest that you need to know as we start another session. So hugely volatile day on Wall Street. I think that's point number one. The rates market saw a huge sell-off. I mean, the two-year yield fell 47 basis points. It's on a 3-day time frame. I mean, if you count the amount that the two-year yield has fallen in a 3-day time frame, it's the largest fall ever. It's the largest 3-day fall in history in the US. So it's gone from basically 5% to 4% just like that. By the way, the intraday low was 3.9 something. So it fell actually below 4% and then came up 2 here. Which means that the market has completely priced out the sort of March rate hike. Not just with the Fed, but with the ECB as well. You know, the rate hikes have vanished. That at least the immediate next meeting pricing has completely vanished. So with yields plunging like this, what's the pocket of market which does the best? It's tech, right? I mean, NASDAQ went up about 0.5% or so on the plunge in yields, and there was a little bit of stability in that part of the market. Actually, I would say the broader market stabilized a little bit. I mean, they came off. I mean, equities came off a little bit off the lows, and the stocks did rebound. Generally, NASDAQ, of course, did a little better. But this is not to say that the bank contagion fears are not there. So if you look beneath the surface, the indices, the major indices of the S&P, the NASDAQ, and the Dow, they're okay. But the contagion fears continue to fester. And to that point, you look at there is a good measure of the overall sort of listed banking universe in the US. That fell 7%. Actually, 11.6%. That was the overall bank index. There is a good measure of the regional bank index, which is where the problem is. Signature Bank, Silicon Valley Bank, these are all regional banks. And an index made up of these banks fell another 7% after falling for the last 3 sessions straight now. So the banking problem, banking contagion problems continue to fester. We'll discuss this. This has been the main discussion point here. Now, investors today will await the February CPI data, inflation data. Had we not got this entire Silicon Valley Bank fiasco, you know, it would have been jobs data, a market which was inconclusive, and then you basically would have waited for the CPI, which would have been the decider. But for the CPI to be able to change direction in any meaningful way, the bar is very high now. I mean, it really needs to be a huge beat for markets to price those hikes again. I mean, price in those hikes again. It's priced out the hikes, but for it to say, well, in March, we will see hikes, the CPI number needs to be a blowout. So the bar for surprise from tonight's data is very, very high. Just 2 points on the local market here. I mean, I think with all that is going on, I mean, this is a very interesting market, so much debate, etc. going on. That does not necessarily mean that you need to jump in and trade the market all around. It's very volatile, and it can be very unprofitable as well. I would say this is a wait and watch market. Just to put some levels there, for the Nifty, I mean, we basically closed below 17,255 level. It indicates a fresh breakdown. And unless we are able to come up back above this level, the downsides open up to 16,950 levels, which is not very far away with the pace that we've been keeping. On the Bank Nifty, we need to see a recovery above the 39,750 level, which is basically the big support that got broken yesterday. And unless that happens, the downsides open up to the area of around 39,300 or so. You know, it's, as I said, we live in interesting times. on the one hand, you've got the Fed, which is trying to fight inflation, and on the other hand, it is trying to save the banking system. And the question is, what is priority for the Fed at this point in time? Right now, I mean, I thought yesterday's fall in the Nifty, the market here was excessive, perhaps a little unwarranted as well. We did see a 70, 80 point recovery yesterday. You can look at Asia this morning and say, well, it's all in the red. But the fact is, Asia was higher yesterday when the market here sold off quite aggressively. So we may have paid our fees yesterday to some degree, more than some of the other Asian markets. So, I mean, I'm not saying that all is well and, you should go straight in. But the fact is, it could get better. No one knows beyond a point. But with what we know, the information that we have, it is perhaps possible that this gets contained. The contagion fears themselves get a little contained, and we get to normal kind of markets in the coming days. Sonia.
You said we live in interesting times 3 times already. So are you sure you're... this is not a precursor, it's not a lull before a storm or something?
I thought we went through the storm, Sonia. Now we need some lull.
Prashant, you're saying interesting times, and that got me thinking, what are the odds? There have been only 2 bank failures in US history. At least Prashant and I have commentated on both of them. Washington Mutual in 2008 and now this. Who would have thought it? In one lifespan in the history of the United States.
Yeah.
Okay, and hopefully there won't be any more, right?
Really, yes.
But I mean, the point that we were making yesterday as well, the market was weak in any case, whether SVB or no SVB,
Exactly.
right? The Indian markets were trending lower. It just needed, I guess, that little bit of a nudge, and then it sort of fell off the cliff yesterday, and that's pretty much what happened. This morning, yes, the SGX Nifty is indicating that the start will be in the green, but let's not forget that the market has sliced through a lot of key levels. Yesterday, we hit a 5-month low. In fact, there was large selling by FIs for a second straight day, so that seems to be a bit of a concerning factor. In the last 3 sessions, FIs have withdrawn over 4,000 crores in the cash markets alone. And, a lot of things, right? I mean, there is a snowball effect that's happening, not just in the US markets, which have fallen for 5 days now on the Dow. The US 2-year Treasury yield saw its biggest 3-day decline yesterday. Now, there's definitely a pause in the rate hike. So that is one thing that the market is firmly betting on, that give and take all that's happened in the last 48 hours, the Fed will not go ahead with a rate hike in its March 22nd policy. So that seems to be something the market is working with. US President Joe Biden, of course, we'll talk a little more about that. He's assured depositors about the safety of the banking system. So that assurance has come through from the regulators, from the president. We saw what happened with HSBC, where they went and, they were the white knight for SVB UK. But for the Nifty itself, a lot of levels have been breached on the downside. In fact, the Nifty is now down 600 points from the March 8th closing level that we saw. And a couple of things to watch. We've sliced below the Feb 28th low. The next level would be the September 2022 low of around 16,800. I'm not saying we get there, but that is 16,800 to 17,000 is the next line in the sand for the market. So watch out for that. And the 200 DMA on the upside will act as a key resistance. So these are the markers. Even if there is a bit of a relief rally today because of what the SGX Nifty is suggesting and post the comments from Joe Biden, the sell-on rally is something that could play out. So caution is definitely the name of the game in the market now. And, we have a lot of big events coming up. There's a lot of US data, etc. There is the FOMC policy. Ahead of that, I think no aggressive bets would be taken. But I won't be surprised at any point in the day if once again, this sell-on rally trade plays out.
Oh, yes, that was a problem yesterday, right, Sonia? Because despite what the Fed said, despite what the Treasury said, the markets just didn't want to listen. It was a mini tantrum of sorts. I mean, the way I saw it, especially in the afternoon with European bank stocks falling, 7, 8, 10%. It's the large corporations that we're talking about, the likes of Credit Suisse. I think what really helped stem some of that absolute panic and mayhem was the statement from the US president, where President Joe Biden assured Americans that the U.S. banking system is safe and that depositors would have access to funds when needed. Let's just hear out that comment once, and then we continue our chat.
All customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers.
That's a reiteration coming from the U.S. government almost on an hourly basis in this crisis. In any case, it really helped the dollar pull back. The dollar was slumping, remember, at this time just yesterday. And now, again, it's heading towards that 104 handle. So there's some sort of cool off in just the level of risk in the market, the level of panic in the market. There we go. We're approaching the 103.8 level as of now. Just a word on inflation here in India, and it goes to show that this is a long drawn battle. It's nowhere close to completion. Look at the numbers. The numbers are still elevated. Inflation is extremely sticky. It's only a minor, snitch below the January level at 6.44. It was above street estimates for sure. And the problem is that core inflation has not moved at all. It's extremely sticky and rigid at 6.1%. No let up in core inflation. This is something that's going to play on the RBI's mind. We'll see how Indian yields react to this. Though, of course, overall, there is a cool-off in yields because of the anticipation that the Fed is going to take its foot off the pedal. So that's something to keep in mind. I'd like to end by just pointing out banks. And that's the one pocket of the market that at least I will watch extremely closely, because banks have led this decline this year, this month. Whether you're looking at the Nifty Bank or the PSU Banking Index or the Private Sector Banking Index, there is a lot of sort of chaos that's played out in bank stocks, especially in the last 2 or 3 days. At some point in time, as Prashant said, perhaps this is getting a little excessive because there's no one-on-one correlation between what's happening in India and what's going on in US banking. So at some point, perhaps money starts trickling back in. And we know the moment money comes in banks, that tips the needle for the overall market as well. So I'll watch out for that.
Do you guys remember the UK pension crisis, right?
Yeah.
Recently, the pound was selling off for about a week or so. And it seemed so intense when we were living through it. And it lasted basically a week. The Bank of England stepped in. They provided liquidity and then went on their business of hiking rates. That's the normal world we know, which is central banks increasing interest rates. I think Neelkant makes a very good point. We're going to put that quote out that some of these accidents are bound to happen when you increase interest rates at such a fast pace.
Frenetic pace, absolutely. And interest rate sensitives, not just banks, right? If you look at the performance this month, auto stocks also down quite a bit. So all the interest rate sensitives, banks, autos, real estate, are under pressure in the last fortnight or so. But lots to talk about. It was a very disappointing day yesterday. It's a 5-month low for the market. And let's see how today shapes up. At least the SGX Nifty is indicating a start in the green, but this has been a sell-on rally market. On the equities front, we have a comment coming in from Neelkant Mishra of Credit Suisse. He says the severity of contagion triggered by the run on US bank SVB and its closure last week will depend on regulatory decisions, like if depositors will be made whole immediately. But were SVB's troubles idiosyncratic, like an undiversified depositor base and no rate hedges, or should we fear more accidents? To which Neelkant says we should fear more accidents. So definitely this is not the last of it. Perhaps there could be more coming. And now they're talking about, not just a recessionary situation, but also perhaps layoffs in the financial space in NBFCs, etc. So that's the next big thing to worry about.
Oh, absolutely.
And something we have enough to worry about already.
All right, let's get you some money market views now as well. On the rupee, this is Bhaskar Panda of HDFC Bank, who says that the collapse of Silicon Valley Bank has had major impact on not only banking stocks, but has also forced a rethink on US Fed action on interest rates, causing major volatility in US yields. He says dollar index down and a shift to safety is in vogue now. Given this global backdrop, he adds, the USD INR pair rallied from around 81.72 to close above the 82 to a dollar mark yesterday, which means the rupee actually weakened quite a bit by close. He says uncertainty would make it even harder to make directional calls now. Hence, expect the USD INR pair to remain volatile and trade in a range of between 82.2 to 82.5 to the dollar.
And on bonds, Mr. Bhaskar Panda says that benchmark yields reacted to major moves in US yields and therefore moved down. He says any further down move will be event-based, but he feels the 10-year benchmark will now consolidate within a range of 7.35 to 7.4% for the day.
All right, we do have a lot of stock-specific action to track today, so we'll get straight to that in a bit in our special Top 10 segment. We're looking at Sona BLW. Remember, there was that big exit from Blackstone yesterday. More on that in a bit. Bharti Airtel, GAIL, Lupin, Tube Investments, Asian Paints and Indigo Paints. That's on our radar on the back of positive news flow. Mahindra CIE, Mahindra Logistics, a lot of Mahindra Group stocks, and ONGC also on our radar, likely to open in the red. But first up, we have a view coming in from Rana Gupta. He's the Portfolio Manager, India Equity Specialist at Manulife Investments. He joins us now. Rana, good morning and thanks for being with us on the show. That's the big question on everyone's mind, right? Is it done with SVB and Signature Bank, or is there more to come? Now, no one will know the answer to that, but as an equity specialist, what are you doing with your money? In the sense, are you recommending investors to sort of, raise cash levels, take a back seat as far as equities is concerned? And what do you think would be the way forward over the next couple of months?
I think the next couple of months is definitely going to be quite volatile. Now, regarding SVB, I think the contagion, given the steps taken by Fed and the U.S. authorities, the contagion will be contained. But I think the message is that higher rates are now impacting, is going to impact the growth. And the markets are telling you the market is expecting credit growth to slow down. Now, that's something which will have a lot of impact in terms of economic growth slowing down. That would mean that, in the U.S., anyway, we're looking for growth to slow down in the second half of 2023. And it looks like this event is going to trigger some of it. Having said that, I think, in case of emerging market equities, I think the emerging market, given by the China reopening and given the, in case of even India, the stability of the financial system and the infrastructure investment improvement in the macro, I think emerging markets continue to be in a better spot. That said, I think next a month or so, things will remain volatile. But I think for the medium to longer term, the emerging market outlook still remains quite constructive.
Mr. Gupta, so let me ask you a follow-up to that. India has anyway been underperforming the world. Even before a lot of these global US problems hit us, we've been a really poor performing market in 2023 so far compared to most key markets. Do you see that changing? At what time, at what point does India start becoming attractive, and would you be deploying more money here?
I think India's underperformance, firstly, a contest underperformance. India has outperformed in 2020, 2021, and 2022. So in that context, 23 performance is really a small thing. But I think the underperformance that has happened this year has taken out some of the valuation excesses that built up, particularly related to other emerging markets. So I think, with that being gone, and given the uncertainty created by US and the economic slowdown, the global slowdown that might happen, I think the investors will increasingly looking for markets which is a pretty large internal market and a pretty strong, the fiscal and the current account position and the strong banking system. Fortunately, India ticks all these boxes. And on the top of that, the two major global trends that we have been seeing, which is which is China plus one and the manufacturing reshoring and the restored supply chain, we would expect that to continue. That investment in to continue. And the second thing is the digital economy will continue to, I think, grow. So I think these two trends will remain pretty much intact for medium to longer term. Short-term volatility will happen.
Rana, we're getting a lot of FI selling here in India. Is that likely to continue if you believe this is a continuation of, selling the hugely outperforming markets and buying the cheaper markets, which was the thing which was happening most of this year, starting the end of last year? Where are we at in that process, in your opinion?
See, that process started somewhere, as you rightly pointed out, sometime like in October last year. So this process has run about 6 months. How much it will run, always difficult to say. But, I would think that this process can continue for some more time because, given the overall financial market volatility, there will be losses. And people would take money out where they have profits or, over a 1 to 3 year basis. So that's why I mentioned my comment was that in the short term, if you take a month's view, things will continue volatile. But given the medium to long-term opportunity, that could be a good entry point. That could be good for longer-term investors.
All right. We will watch out for both the short and the medium term. Thank you very much, Mr. Gupta, for joining us for that quick chat today. We do need to take a break with the news that the SGX, of course, is holding up about 0.5% right now. So we'll come back and see how it goes. As we take this quick break, here's a programming reminder today. CNBC-TV18 will host what will be India's largest summit on gender parity in Delhi. Women leaders from all walks of life will come together to brainstorm and ensure we take decisive steps to bridge gender inequality. The event starts at 4:30 p.m. and we will bring you live coverage right here on CNBC-TV18.
Welcome back to Bazaar Morning Call. We begin a brand new day. Well, the SGX Nifty is indicating a start in the green, but we know better. We've had a rough last couple of days. This market has been a sell-on rally market. So today, perhaps, we could see a pullback rally, but important bit is whether it gets sold into or not. A lot of block deals coming through as well in the last 48 hours, 24 hours rather. Vivek is here to give us the latest on all of that. Vivek, over to you.
Well, good morning. Yesterday in the trading session, we saw multiple block deals and quite a large chunk of equity in each of the companies actually exchanging hands. We reported yesterday on Sona BLW, and we had intimated that Blackstone would be the likely seller of almost 20.5% stake that was sold in the company. Along expected lines, they have sold almost 25%. However, when you're looking at the list of names that have bought into this particular block deal, it's a list of marquee names. So it's actually seeing demand from FI, you saw sovereign wealth funds, domestic mutual funds, as well as insurance companies actually coming in this particular deal. In fact, CLSA has written a note saying that the recent underperformance was, from the stock was on the back of the fact that on the anticipated supply from Blackstone. However, they believe that the prospects continue to look quite good and the order book is extremely healthy. We're also talking about Mahindra CIE. Yesterday, M&M sold almost 6.1% stake in the company, like we had reported. They continue to now hold a 3.1% stake, and it remains to be seen, what exactly they do with this particular stake and as and when they decide to exit it. Lastly, Mahindra Logistics, a large fund, holding almost 2.23% stake at the end of the December quarter, exited 1.7% stake yesterday. It's the first Sentia sustainability fund. Remains to be seen, with the small stake, what exactly they do with it.
Okay, all right. Thanks very much, Vivek. So you're our man for all the block deal data. Thank you for the details over there. Let's bring in Rima. She's looking out for Bharti and for GAIL. Rima, morning. I think anyone who was listening to us on Who Moved the Market would know that you were talking about this. Bharti will go forward with price hikes in all the remaining circles. That's what's happened?
Yes, indeed. So Bharti Airtel has increased the minimum entry level tariff plan in 3 more circles. They are Gujarat, Kolkata and Madhya Pradesh. With this, Bharti has now increased the entry-level tariffs from 99 to 155 rupees across India, across all the 22 circles. So now it's a pan-India tariff hike of almost 56%. But remember, it only impacts a very small percentage, only the voice customers of Bharti Airtel, which is why, while it's a step in the right direction, it's not very material to the company's financials. So according to Morgan Stanley, with this, the India mobile revenues go up by only 1.3 to 1.5%. Many other brokerages believe, given the churn that typically takes place, the impact is not going to be more than 2%, say 1 to 2% at best. So that's the expectation. Competition so far, competition here is Vodafone Idea, has not followed through or followed Bharti with a price hike. GAIL is the other one that we're tracking today because they have declared an interim dividend of 4 rupees per share, and the record date for this is the 21st of March. Back to you.
All right, Rima, thanks a lot for that. Well, let's go across to Ekta now. She's tracking Lupin and Tube investments. Ekta, what do you have?
Thanks for that. Well, I'll start with Lupin, where the US FDA has completed an inspection of its bio-research center in Pune with no observations. And this is the 7th consecutive on-site inspection which has been cleared. So that is a positive for Lupin. Remember, their Vizag facility was cleared with 0 observations just 2 days ago. So that's definitely positive news as a whole for Lupin. And Tube Investments, they're foraying into contract development and manufacturing, which is basically the CDMO segment. They've incorporated a subsidiary for the same and will be investing 285 crores. So interesting times. Let's see. I expect both these stocks to probably be in the green.
All right, Ekta, thanks very much for that. Well, oil prices in focus, which is something we've not discussed. We've talked about equities, rates, etc. Manisha is here to give us a lowdown on that. Manisha, hi, morning.
Well, yes, we have seen the crude oil prices decline down by 2% overnight, and with that, we are down by 4% in this week and down 6% on the month as well. And the crude oil prices now are trading at a 3-month lows. The weakness in US dollar and the China demand recovery have been the supportive factors in last many sessions, but the collapse of Silicon Valley Bank has raised concerns about a broader financial and economic crisis, and that has triggered a sell-off in risk assets. Also, if you look at the EIA report that came in last evening, says that the US shale output will increase in April to the highest since December 2019. So supply is clearly not a concern, and markets still are looking at uneven, even fragile recoveries from China that continues to weigh onto the market. So we are trading below $80 for the Brent prices. We've seen 86 of a high in the month of March itself. So a very sharp cut coming in, with the markets now suggesting that another couple of dollars of a decline in this week now is not proved out.
Okay, Manisha, thanks a lot for that. Well, tying in with all of this is inflation, right? It remains quite stubborn. In February, it came in at 6.44% above the RBI's comfort zone. Lata's here to give us the fine print. Lata, over to you.
Yes, it's above the RBI's comfort zone, but more importantly, above our forecast as well. The poll said 6.29%. And what is leading it is, again, something of mass consumption. Cereals up 17% versus 16% last month, and milk up 9.7%. It was 8.7 last month. So it's really a widespread and biting inflation. The core inflation, which RBI tracks, is also at 6.1. RBI had said in the previous policy it wants to see it persistently lower. Now, there are some people who are arguing that the manner of calculation of food inflation is a problem. Be that as it may, the MPC has a given mandate of keeping inflation below 6%, and that it's come at 6.44 in Feb, 6.52 in Jan, means it has to come, at 5 in March for the average for the quarter to come down below 6, which is not happening. So they're going to miss their mandate again. Part of the street is therefore betting that an April rate hike is a given, because this is becoming a structural inflation. But the other part argues that look at the global cues. We will get the Tuesday evening, our time, US CPI numbers, FOMC decision on 22nd March, and the manner in which the global markets have been disrupted by the banking instability will anyway bring growth lower, and therefore monetary policy should be forward-looking and there should not be a rate hike. So April policy becomes extremely interesting.
All right, Lata, thanks very much for that. That's India inflation coming into sharp focus, as well as we've been discussing. US inflation, of course, comes into focus later tonight. We'll take a very quick break here. Up next, Aditya Suresh of Macquarie will join us now for some fundamental stock analysis. Later, we will connect with Rajiv Samant of Sula Vineyards to discuss their business outlook, as well as the recent resignation of their CFO. Stay tuned for those conversations coming up next.
Welcome back. We still have a little bit of green on the SGX screens, though it's slightly off the highest levels of the morning. But about a 50-point pop is what the SGX is indicating. Let's take the conversation forward with Aditya Suresh, Head India Research and Strategy at Macquarie. Aditya, great to have you on the show. There's so much going on, right? And plenty of news flow. You tell us, from Adani to the underperformance that started in 2023 to this whole conversation on rates and now US banks. In the midst of all of this, how do you find the market positioned? Have valuations started reaching comfort levels where you see perhaps some more foreign money flowing in?
Sure. So at the start of the year, our view was that India pulls back by about 10%. We underperform by about 15%, and we're kind of firmly on that path. Now, valuations have clearly kind of come in here. India's kind of cooled off. Other emerging markets kind of rallied a little bit. But I think there's still a lot of water to flow. So it's our view that maybe we see another 5% correction from where we are today. So it's our view that in the next, say, 6 months, it's more likely from a nifty perspective, we get towards 16,000 than, say, rally towards, let's say, 18,000, 18,500. So I think the top-down construct remains fairly cautious.
Top-down construct remains cautious, but you're saying that there could be, at worst, another 5 to 10% downside from here for the Indian markets, right?
That's our base case position, and that's premised really on what we think about earnings growth and all these things.
Okay, so, that's not bad, another 5 to 10%. So if we are at perhaps the last leg of this downfall, or the penultimate leg, is this a good time to be accumulating in the market? Is it a good time to be nibbling in? And if yes, what are the pockets that interest you now?
For us, the answer to that question is very clear, and it remains very, very selective. And this is kind of where we think that there is strong earnings visibility, or where kind of consensus estimates are mispriced. And so selectively, again, in financials, we like a few of those names, particularly in the larger kind of banks. IT, again, has been an area where we have been anti-consensus optimistic, whether it be large cap, mid caps, etc. Elsewhere, it becomes very, very bottom-up and stock-specific. So, for example, so GAIL's on TV today with that interim dividend. So GAIL's been one of our top picks, right? And that's more a value play. And there's been like specific events with that stock, whether that be kind of the tariff or dividends and the improvement in earnings, etc. So I think just to give you a flavor of kind of how we're thinking about markets here right now, there is no overarching kind of subsector theme which we're backing or betting on. It is very bottom up.
It is very bottom up. Do you, when you say another 5%, I mean, right? I mean, these are always in the ballpark. Can't really pinpoint. But how can you just run us through what your earnings growth expectations are, and where are we going to see this either a turn in earnings, or is this just the market falling to where earnings are right now? What will cause an upturn is what my question is, Aditya, and where will that earnings surprise come from?
And I think that's the way we think about this as well, right? In that, so if we were to kind of meaningfully rally from where we are today, despite the valuation kind of pullback, we really need to see that earnings surprise kind of come through. So just to give you some perspective on our estimates, I'll use MSCI India as maybe as a proxy, but I think the Nifty story is similar-ish, which is that, you know, when you think about 2-year forward earnings estimates, which I think has had a very strong correlation with broader markets, consensus has been cutting by anywhere between 10 to 14% over the past year. So it's been fairly sharp cuts. Even so, today, kind of the 2-year forward EPS growth story is about, say, 15% for consensus. On our own kind of bottom-up math, we get to about, say, 12, 13%, right? On our own kind of that 12, 13%, what we're saying is that even if I apply, say, an 18 times 2-year forward on this, I would see about, say, 5% say downside to MSCI India. Within this, I think the main themes are about kind of, when you think about earnings, again, so like financials and IT have been areas where you're actually seeing earnings upgrades. But the entire kind of overpowering kind of message has been about the margin cuts elsewhere, right? Whether it be in consumer, energy, materials, all these kind of sectors. So I think where we would expect, to the extent that we had to see a turnaround in earnings again, I think the margin downside that's already in the base across a lot of sectors, right? So what really this has to be driven by is that volume recovery story surprising on the upside. And on that, again, I think a lot of the real-time indicators that you're looking at, it's faltering, right? So whether it be kind of optimism on the manufacturing sector, exports, even say top-end consumer spending, it's kind of flatlining. Pent-up demand is kind of, those effects are kind of easing. So it's going to be volume-led incrementally for us to rally from here.
Okay. Aditya, let me just take you up on that point on IT a little further, because that's an interesting call. I heard you talk about upgrades, and you know that's what makes you a little optimistic. But it's also a highly exposed sector to everything and all this noise and headlines coming from the US. Doesn't that worry you? And within IT, what kind of stocks and companies are you picking?
No, exactly, right. So I think there's an element of when you actually look at estimates again. So the top line kind of growth for IT is about, say, 12, 13% over the next, say, 2 years. I would concede and we would admit that there is downside risk to those estimates. And I think all the headlines, which are more recent, that probably kind of exacerbates that risk. So there is kind of cuts there on the revenue side, which I think are still to be captured and factored in. But I think on the other side of the story is that I think margins have clearly bottomed. There's been very sharp cuts to fiscal 24, fiscal 25 margin estimates. And so we think there's a bit of that offset there to kind of to balance out some of these cuts on the top line. Still, I think IT is an area where if the question is, can this sector grow at, say, 12, 13% EPS, and do you have visibility on this? Selectively, again, we do have visibility on this, and valuations are kind of pulled back. Names in itself, it's not just the large caps. So we do like a few mid caps. In the large caps, HCL Tech is our kind of top pick.
Okay, HCL Tech is your top pick. Got that. Aditya, we thank you on that note. Thanks a lot for joining in and talking about some themes, some stocks, and the IT space that we just spoke about. That's Macquarie with their view. But let's talk to some corporates now. Sula Vineyards is the first corporate on our radar. A couple of days ago, the company's CFO, Bittu Varghese, resigned from his post, and post that, the stock was under a bit of pressure. Of course, the going has been very good, given that the whole hospitality industry has picked up in a big way. So let's find out more on what's happening with the business and how this resignation could impact operations. We have Rajiv Samant, the MD and CEO at Sula Vineyards, who joins us now. Rajiv, this is a minor deterrent, I'm sure, the resignation of the CFO. But tell us a little bit about A, why it happened, B, what is the next step? Have you found a CFO already? How long will the process take? And in the interim, will you be taking on the mantle?
So as you say, minor deterrent, those are your words. Of course, it does happen that people come and go. I think the important thing to ask is it a very sudden departure, or is it, going to be in a phased and planned manner? And the answer to that is that Bittu is very much going to be on board Sula for the next 3 months. So, that's about as good as it gets. He's going to take care of the FY23 financial accounts closing. And hopefully, we will have a new CFO, his successor, on board before he leaves. So there will also be a smooth handover. Today, Sula is a well-run company, firing on all fronts. And so I don't see this as a big blip for us. However, having said that, of course, we'll miss him. He's been a great part of the team for the last 4 years. He was an important part of the team that took us to IPO, but we wish him all the best with his future prospects.
Rajiv, hi, good morning, got that. Now, let's move on to the other issue, which is the unseasonal rains. We've been reporting, our team has been in Nashik, around some of these areas which have seen these unseasonal rains. You told us last time we were on that the harvest is going on very good, it's looking solid. Jan to March is the harvest period. Can you tell us, can you give us an update? Has anything been affected?
So I'm very pleased to say that wine grapes have not been impacted at all by these unseasonal rains. Over the last couple of decades, we've really learned a lot about mitigating climate change. So unseasonal rains actually is nothing new for us. Though in the season, it's unseasonal. When you start looking at it on a long-term basis, it's very much something that we need to expect and we need to prepare for. And I'm happy to say that it looks like this year, so there's a couple weeks left to go before the wine harvest ends. Generally, it's around the last week of March or first week of April that the harvest ends. Looks like the third harvest in a row of great quality and great quantity, putting Sula in a great position for the next 18 months. Lots of really good quality wine in the tanks. And so it's actually some good news that I have to talk about today.
Oh gosh, Rajiv, you're almost prompting us. I almost feel like making a trip to Nashik. But anyway, that's on a lighter note. Tell us about the business.
Trip, probably too early in the morning for our tasting room.
Sounds good right after markets close. But okay, let's get back to business. Tell us a little more about how the fourth quarter has been and demand trends. I mean, up until the third quarter, business was very good. Your margins have been really booming. Fourth quarter onwards, after the festive cheer has worn off, and there's a lot of more somber talk around, just in terms of sentiment, business sentiment, global sentiment. Has that started impacting the premium end of your segment or even the mid segment at all?
I'm pleased to say that we are not seeing a significant impact, negative impact. The wine story remains a very strong one. We have to remember that, the wine story starts from a very small base. And so, the growth, it's usually a couple percentage points here or there, but solid growth continues. And this is what we see for the next few years ahead. So no negative surprises in Q4.
Okay, glad to hear that. And every time you come on CNBC-TV18, you so graciously invite us to your vineyards. Thank you so much. Last time you said that we should plan a corporate offsite over there. I'll not forget that. I'll pick it up.
So I'm going to repeat it. We look forward to welcoming you and everyone. You know that Sula is the most visited vineyard in the world.
Oh, is it? That's great. That's great to hear.
It's so crowded at times. I've had to go back because on the weekends, they draw in such huge crowds. But obviously, some amazing wines and a great place as well.
Okay, so we know where to go next.
I'm glad to hear that I'm talking to wine drinkers on this show.
Well, thanks a lot. And I can't wish you a great weekend. I mean, it's midweek, so... but have a good one, Rajiv. Thanks a lot for joining in. And thanks for all those clarifications as well. Okay, let's take a quick break on that note. On the other side, Mitesh Thakkar, Sudarshan Sukhani will be joining in for some technical trades. Stay tuned.
All right, welcome back. We're just 10 minutes out from the pre-open session. Anuj is here with a quick take on how he sees the trade setup to be. Anuj, morning. I mean, markets are markets, right? I mean,
yeah.
Interesting to report on.
Yes, absolutely, Prashant. Morning, Sonia. So good morning.
Hi, morning.
Just one of those days or those phases when everyone is latching on to Warren Buffett quotes and, reading the Morgan Housel's money psychology books and all, because, that's what you can do in times like these. But typical greed and fear market, my sense is that, you're now approaching peak fear and a good time to enter market now, both technically and fundamentally, the Indian market that is, because the fall is because of the global factors and that normally gives you the best entry opportunity. Bond yields are falling, by the way. Right now, the equity market's not taking cognizance of that, but the way drastically the US bond yields have fallen, I think at some point you'll recognize that that's equity positive in terms of how you value, Indian equities. And there's panic, but there's no reason for Indian banks to fall the way they are. But anyway, traders should respect the screen and see how it's acting. If it's showing you sell on rally, then you have to do sell on rally. There's a couple of points. I think IT stocks could be very interesting because Nasdaq closed at a very important level and Nifty IT is now very close to 200-day simple moving average. And my sense is that's something that can now actually lead any kind of recovery. On the Nifty, you need to take out 17,440. Till then, it's sell on rally. 17,440 is a 200-day simple moving average on the Nifty. And the Bank Nifty is very interesting because that's now poised at a make or break level. I think 1,000-point moves here on both sides open up. Depending on how it does today, because it closed at 200-day moving average yesterday. Simple 200-day moving average. Also, yesterday's low was very close to the budget day low. I think if anything, aggressive traders perhaps could look at a contra long on Bank Nifty today, provided the first hour low holds. But let's see, the screen has been, of course, looking quite weak. But again, as I said, my sense is that this is the best time for you to perhaps take a bite of the market, or if you're a portfolio investor, maybe get in here.
But there's no reason for that range to be broken either way, right? Even if there's a pullback, it will still be within that range, you think?
Yeah, but Sonia, range actually has been quite large. I think till last week we were at 17,800.
Yeah.
Now I think we're at 17,200. Either 16,800 is a level which my sense is should not break even in the worst of the panics. But of course, that's also 400 points down. For traders, that's a lot. But I think you will never catch the bottom. So as I keep saying, the moment you buy, the market will give you 100-point dip. But that's the nature of the market.
Just have to take it in your stride, I guess. Take your point, Anuj. Thank you very much. Have a good day. Let's take the conversation ahead and actually get some more technical inputs on this. Mitesh Thakkar as well as Sudarshan Sukhani are with us. Good morning, gentlemen. Well, we hope you're well rested and ready for today after yesterday's roller coaster. So, Sudarshan, let's talk about this. I mean, levels were broken. Nothing was sacrosanct yesterday. How do you approach the market this morning?
Yeah, good morning. See, the approach is the same as yesterday when I said that volatility is too high to justify trading. The only way traders can look into enter this market is by following some intraday rules, intraday charts, not just rules, and then going with the very short-term trend and then exiting quickly. This is easier said than done. It's not so easy, not as easy as it sounds. The same view applies today. Volatility has not come down. There are so many measures, but one simple measure is look at the VIX and how it has jumped up. So traders should stay quiet till volatility comes down. You don't make money when markets are going up and down randomly. So be patient. If at all you want to trade, and that's big if, then you again have to track intraday charts and go with the very small time frame trend. But ideally, most traders should step away.
I mean, markets are, as I said earlier, it's very interesting to comment on and extremely rich, but could be unprofitable if you're trading in the near term. So wait and watch. Mitesh is with us as well. Mitesh, hi, morning. How are you looking at things? Yesterday, of course, I mean, there was a bounce which got sold into and how, and then from the lows there was a bit of a recovery as well. So how are we poised?
Good morning, Prashant. Yesterday we were, very clearly aggressively on the sell side with the bounce immediately getting sold into. And we also towards the end of the session were suggesting that take part profits off. Now, if you look at the decline which happened in the month of September, October of 22, we got a weekly closing low around 17,094. So 17,100 was some kind of a pivot for us, round number, and a weekly closing low earlier over there. So we covered a good part of our short positions. But the structure is weak. So idea is that while at this level, it may not be very favorable risk or equation to enter into short, the idea is that rally should be used to get into short positions, and trading should be more on the sell side with stock specific ideas as well. So on the index per se, I think anything closer to about 17,400 odd levels would be excellent entry opportunity for taking fresh short positions. So even if you don't want to go full into, you want to take the full short position in one go, then I think take part position at 17,400, take part at about 17,450, and keep 17,520, 25 as your stop loss level. I think these lows, will be revisited. There is a chance of us breaking below that also, but we'll take that forward once we do that. But idea right now is to use any bounce back in the markets to short into it. Not a 40-50 point bounce back, but a one-day kind of rally which would see us about 200 points higher from here.
Okay. So since you said it's going to be a pretty stock-specific market, let's do one thing. Let's take a quick commercial break, but don't go anywhere. When we come back, we'll talk about those very stocks that you need to trade. This morning, we will also have Apurva Prasad of HDFC Securities to talk about the impact on the technology space post the collapse of Silicon Valley Bank and an overall outlook on the IT sector. That's coming up in just a bit.